Don't put all your eggs in one basket. Diversification explained. In the world of investing, diversification is like a safety net. It means not putting all your money into one stock or one type of asset. Instead, you spread your investments across different assets to reduce risk. Think of it like this. If you invest all your money in one company and it goes bankrupt, you lose everything. But if you invest in 10 different companies and one goes bankrupt, the impact on your overall portfolio is much smaller. Diversification is crucial for investors of all levels, from beginners to seasoned pros. It helps protect your capital and improve your chances of long-term success in the stock market. Remember, in investing, it's not about trying to hit home runs every time. It's about consistent, steady growth over the long haul. Diversification helps you achieve just that. Diversification superpowers, unleashing the power of variety. Diversification is not a one-size-fits-all concept. There are various ways to diversify your portfolio. Invest in different asset classes like stocks, bonds, and real estate. Spread investments across sectors like technology, healthcare, and energy. Invest in international markets for global growth. Invest in companies of different sizes. Diversification balances risk and reward. Real-world diversification. Building a portfolio for stability. Let's break down diversification with some real-world examples. Imagine you're interested in asset class diversification. You could invest 60% in stocks for growth, 30% in bonds for stability, and 10% in real estate for inflation protection. For sector diversification, you might allocate 25% to technology, 25% to healthcare, 20% to financials, 15% to consumer staples, and 15% to energy. When it comes to geographic diversification, consider investing 70% in US markets and 30% in international markets, including emerging markets for potential high growth. For market capitalization, you could have 50% in large-cap stocks for stability, 30% in mid-cap stocks for a balance of growth and stability, and 20% in small-cap stocks for higher growth potential. Finally, for investment-style diversification, a balanced approach could involve 60% in growth stocks and 40% in value stocks. Remember, these are just examples, and the ideal diversification strategy for you will depend on your individual circumstances. Section 4. The benefits of spreading your bets. Why diversification matters. Diversification offers significant benefits for investors. Firstly, it reduces risk. By spreading your investments, you're less exposed to the ups and downs of any single stock or asset class. If one investment performs poorly, others can cushion the blow, protecting your overall portfolio. Secondly, diversification can lead to smoother returns. While it might not lead to the highest returns, it helps avoid dramatic losses, which is crucial for long-term investing success. Thirdly, diversification helps preserve capital. By mitigating risk, you're better positioned to protect your initial investment and avoid significant losses. This is especially important during market downturns. In a nutshell, diversification is like an insurance policy for your portfolio. It helps you weather market storms and come out stronger on the other side. Section 5. Sarah's success story, how diversification protected her investments. Let's look at a real-world example to see how diversification works in practice. Meet Sarah, a young professional who started investing 10 years ago. She diversified her portfolio across different asset classes, sectors, and geographies. She invested in US and international stocks, bonds, and even allocated a small portion to real estate. A few years ago, the technology sector experienced a downturn. While Sarah's technology stocks took a hit, her investments in other sectors like healthcare and consumer staples remained relatively stable. This balanced out her losses and prevented a significant drop in her overall portfolio value. Sarah's story highlights the power of diversification. By spreading her investments, she was able to weather a sector-specific downturn without panicking or making rash decisions. Her diversified portfolio acted as a shock absorber, protecting her from significant losses. Section 6. Diversification done right. Tips for long-term success. Diversifying your portfolio is an ongoing process. Rebalance regularly and avoid over-diversification. Focus on 15 to 20 investments. Stay informed and seek professional advice. Diversification is a marathon, not a sprint.